If you're like most hardworking professionals, tax season can feel like a constant uphill battle, especially if you're making good money through your W-2 or 1099 income. You work hard, you save. But then, a huge chunk of your paycheck disappears to taxes. At Square Accounting, we help real estate investors and small business owners keep more of their hard-earned money. Today, I want to show you how to use rental property losses to legally reduce your tax bill in 2025, even if you're still working a full-time job. We'll break down how to create real estate losses. We'll explain the legal loopholes that let you offset your W-2 income. And we'll cover a little-known tax strategy that could save you thousands. If you're serious about building wealth while lowering your tax bill, this video is for you. And hey, if this sounds like the kind of content you need, hit that subscribe button because we bring you real tax-saving strategies every single week. Now let's talk about why real estate is one of the most powerful tax-saving tools available in 2025. Imagine this. It's the 1980s, and high-income professionals, doctors, lawyers, and business owners are using real estate losses to completely wipe out their taxes. Sounds amazing, right? Well, the IRS wasn't a fan. So in 1987, they introduced the Passive Activity Loss, PAL rules, to stop W-2 earners from using real estate losses to offset their salaries. What does that mean for you today? If you own rental property, you can't use those losses to reduce your W-2 income unless you qualify for one of two tax loopholes we're about to discuss. This is exactly how wealthy investors play the tax game, and we're going to show you how to do it legally. The first way to bypass passive activity loss rules: become a real estate professional. Now, before you say, "I don't have time for that," hear me out. You don't need a real estate license. You just need to meet these two IRS requirements: 750 plus hours per year in real estate activities, and more than 50% of your working time must be in real estate. For most full-time W-2 workers, this is tough. But here's where it gets interesting. If your spouse qualifies as a real estate professional, you both benefit from the tax savings. Let's say you're an engineer making $200,000 per year. Your spouse decides to manage rental properties full-time. If they qualify as a real estate professional, you can deduct rental losses against your W-2 income, saving you $20,000 plus in taxes. At Square Accounting, we've helped countless couples unlock this strategy. If you think you might qualify, drop a comment below or reach out to our team. We'd love to help. And if this isn't an option for you, don't worry. There's another tax loophole that works for almost anyone. Here's where it gets exciting. Short-term rentals, like Airbnbs, aren't considered passive income. In 2025, the IRS still allows an amazing tax loophole where, if your rental meets two simple criteria, you can use real estate losses to offset W-2 and 1099 income. First, the average guest stay is 7 days or less. Second, you actively manage the property. This can be guest communication, coordinating cleaners, or handling maintenance. Because short-term rentals are classified as active businesses, they bypass passive activity loss rules, making them a goldmine for W-2 earners looking for tax savings. Let's say you buy a short-term rental and actively manage it. If the property generates $40,000 in tax deductions, you can deduct all $40,000 against your W-2 salary, saving you $12,000 or more in taxes. If you're already thinking about getting into short-term rentals, this strategy makes the investment even sweeter. Now let's talk about the hidden tax weapon that every real estate investor needs to know about: depreciation. Even though your property may be appreciating in value, the IRS lets you write off the cost of the building over time, reducing your taxable income every year. But here's the biggest tax move of 2025: cost segregation. Instead of waiting 27.5 years to take deductions, a cost segregation study lets you accelerate depreciation, which means huge tax write-offs in year one. You buy a $400,000 rental property. $320,000 is allocated to the building. You take an $80,000 depreciation write-off in year one. If you're in the 30% tax bracket, that's $24,000 in tax savings immediately. This is exactly how high net worth investors keep their tax bills low while growing their wealth fast. All right, let's do a quick recap. Passive activity loss rules block most W-2 earners, but 2025 updates create new opportunities. Real estate professional status, or REPS, can unlock massive tax savings, especially for couples. The short-term rental loophole allows W-2 earners to use rental losses to offset their salaries. And cost segregation is the smartest way to accelerate depreciation and maximize tax deductions. If you're serious about keeping more of your hard-earned money, subscribe to this channel and check out Part 2, where we'll cover how to avoid depreciation recapture taxes and long-term real estate tax planning for generational wealth. If you need help with your real estate tax strategy, Square Accounting is here for you. Drop a comment, send us a message, and let's start saving.